वेलकम टू वीलर्न में आपका स्वागत है। सब्जेक्ट फाइनेंशियल डेरिवेटिव्स, सेशन नंबर 5। टॉपिक कवर्ड इन दिस सेशन: डिफाइनिंग डेरिवेटिव्स, बेसिक पर्पज ऑफ डेरिवेटिव्स, फॉरवर्ड एंड फ्यूचर्स, margin accounts and marking to market, hedging and speculation with futures, arbitrage and futures price, options, using options, American and European options, option pricing volatility. And now, derivatives. A derivative is a financial instrument whose values depend on is derived from the value of some other financial instrument. डेरिवेटिव की जो वैल्यू होती है वो अपनी खुद की वैल्यू नहीं होती, बल्कि इट इज ड्राइव्ड बाय अदर, इसीलिए हम इनको डेरिवेटिव कहते हैं। विच कॉल्ड द अंडरलाइंग एसेट्स। कॉमन एग्जाम्पल ऑफ अंडरलाइंग एसेट्स आर स्टॉक्स, bonds, corn, pork, wheat, rainfall, etc. Basic purpose of derivatives. In derivatives transactions, one party's loss is always another party's gain. The main purpose of derivatives is to transfer risk from one person or one firm to another person or another firm. That is to provide insurance if a farmer before planting can guaranteed a certain price he will receive, he is more likely to plant derivatives, improve overall performance of the country. The major categories of derivatives: number 1, forward contract and future contract. Number 2, options. Number 3, swaps. Options की अगर हम बात करते हैं, forward contract and futures both are agreement, same kind of agreement apart from a few difference. Whereas option दो तरह का होता है, एक कॉल ऑप्शन होता है, एक पुट ऑप्शन होता है। स्वैप्स भी आपका दो तरह का होता है, इंटरेस्ट रेट स्वैप एंड एक्सचेंज रेट स्वैप्स। इसका एक्सप्लेनेशन फर्दर स्लाइड्स में आपको दिया गया है। लाइक फॉरवर्ड एंड फ्यूचर्स, अ फॉरवर्ड कॉन्ट्रैक्ट इज एन एग्रीमेंट बिटवीन ए बायर and a seller to exchange a commodity or a financial instrument for a pre-specified amount of cash on a pre-arranged future date. Example: interest rate forward. In tax, forwards are highly customized and are much less common than the futures. Futures. A future is a forward contract that has been standardized and sold through an organized exchange structure of a future accounts. Seller has short position, is obligated to deliver the commodities or a financial instrument to the buyer, has long position on a specific date. This date is called settlement or delivery date. Part of the reason forward are not as common is that it is hard to provide assurance that the parties will honor the contract in futures trading. This is done through the clearing corporation. How? Through margin accounts. Margin accounts guarantee that when the contract comes due, the parties will be able to pay the amount. So margin accounts and marking to markets Clearing corporation require initial deposits in a margin accounts, tracks daily gains and losses and post these to margin accounts. This is called marking to market, analog or a poker game. At the end of each hand, beggars transfer from losers to the winner. Example, suppose there is a future contract for the purchase of 1000 ounces of silver for $7 per ounce, seller short position. Guarantees deliver of 1000 ounce for $7,000 on the delivered date wire. Long position is obligated to pay $7,000 on the delivery date for 1000 ounce of silver. Suppose price raises to $8 per ounce, the seller need to pay $1,000 to the buyer, so the buyer still only pays $7,000. The seller's margin account is debited by $1,000 and the buyer's account is credited by $1,000. If price fall to $6 per ounce, the reverse happens. That means the buyer's account debited by 1000 ounce and seller's account credited by 1000 ounce. The buyer needs to pay the seller 1000 ounce to ensure that the seller receives $7,000. Hedging and speculating with futures. Often agents hedge against adverse event in the market using futures. That is, a manager wishes to ensure the firm against the rise in interest rates and the resulting decline in the value of bonds. The firms hold can sell a futures contract and lock in a price. Producers and users of commodities use futures extensively to hedge their risk. Farmers, oil dealers, producers sell futures contract for their commodities and insure themselves against price declines. Food processing companies, oil refineries, users buy futures contract to insure themselves against price increases. Speculators try to use futures to make a profit by betting on price movements. Sellers of futures bet on price decreases. Buyers of futures bet on price increases. Futures are popular because they are cheap and investors only needs a relatively small amount, the margin, to purchase a contract that is worth a great deal. Example of leverage. A future contract for deliver of $1,000, face value worth of 10 years, 6% coupon, US Treasury bond, requires a margin of $2,700 through Chicago Board of Trade. Suppose that the price of this contract fell 10 by 32 per $100 face value worth of bonds. The value of contract changes by 10 by 32 multiply 1000, which is equal to 312.5. If you were the seller with an initial investment of $2,700, you gained $312.5, a return of 11.6%. If you owed the bonds and sold the future, you would earn a return of only 0.313%. A speculator. Now, arbitrage and future prices. On the delivery date, the price of the futures contract must equal the price of the assets. The seller is obligated to deliver. If this were not true, it would be possible to earn instantaneous risk-free profit. If bond price were below the futures price, buy a bond, sell the contract, deliver the bond, and earn the profit practice of simultaneously buying and selling. Financial instrument 2 benefits from temporary. Price difference is called arbitrage. Existence of arbitrageurs ensures that at delivery date the futures price equals the market price of the bond. Why? Supply and demand logic. What happens before the delivery date? Principle of arbitrage still applies. Suppose market price of a bond is lower than the futures contract price. Arbitrager borrows funds to buy a bond and sell the future contract. Gets the difference in prices. As instant profit keeps the bond until the delivery dates, pays loan interest with interest earned from the bond. This is costless but earn instant profit. Market eliminates such opportunities. Futures price must be in lockstep with the market price of a bond. Spot market price of 6% coupon 10 years bond is $100. Current interest rate on 3 months loan is 6% annual rate. Futures price for delivery of 6% 10-year bond 3 months from now is $101. What does an arbitrager do? Borrow $100, sell a futures contract for $101, use interest payment from the bond to pay the loan interest. And now option. Like futures, options are agreement between two parties. Seller is called an option writer, incurs obligations. Buyer is called an option holders, obtained right two types of options. Number 1, call option. Number 2, put option. Put option are right to sell an assets at a predetermined price on or before a specific date if assets price is lower than the strike price. It is an agreement, right to sell but not obligation. Option is in the money if assets price is exactly at the strike price. Option is at the money if assets price is higher than the strike price. Option is out of the money. Now, American and European option. American option can be exercised at any date up to the expiration date. European options can be exercised only at the expiration date. Most options sold in the US are American options. However, very few are exercised before the expiration date. Instead, they are typically sold. Understanding profit and loss on futures and options. X-axis measures bond prices at expiration. First, look at the profit from buying a futures contract. You are obligated to pay $1,500 at the delivery date, say June 1st, for $1 lakh. Face value of bond if on June 1st the market price of bond is $100, you have lost 1,15,100. Multiply $1,000, which is equal to 15,000. If 1 June or 1st June the market price is $115, you break. Even if 1 June 1st the market price is $120, you gained implies a linear profit curve for the buyer of a futures contract. Understanding profits and losses. Now consider a case where you bought a call options to purchase $1 lakh face value bond on June 1st for 1,15,000 for a premium of 2,000 $2,000. Come June 1st market price is $100. Do not exercise the options. First June market price is 100. Do not exercise the option. Loss $2,000. Market price is $116. Exercise the option gain. 116 minus 115 multiply 1,000 minus 2,000 which is equal to minus 1,000. At what market price break even? Solution to x minus 115 multiply 1,000 minus 2,000 which is equal to 0. Minus x equal to 117 market price of $120. Minus gain 5,000 minus 2,000 which is equal to 3,000. Get the kinked non-linear profit curves. Using option transfer risk and are used for hedging, speculating. A hedger is buying insurance. Buying a call option ensures that the cost to you of buying an assets in the future will not raise. Buying a put option ensures that you will be able to sell your assets in the future at a pre-specified price. Writing a call options can ensure that a producer will receive a certain payment for its product. Using options speculation. Options are widely used for speculation. Purchasing a call options allow a speculator to bet that the price of the underlying assets will raise. Purchasing a put option allows a speculators to bet that the price of the underlying assets will fall. Pricing option. Option price equal to intrinsic value plus option. Premium intrinsic value equal to value of an option if it is exercised immediately. Options premium. Fee paid for the potential benefits from buying the options. Actual option pricing is pretty complex. Use intuitive discussion here. Example, at the money European call options on the stock that expires in first month at the money means current market price equal to exercise price, says $100 intrinsic value equal to 0 next month. Stock will either raise or fall by $10 with equal probability 0.5, ignore discounting. What is the expected payoff if price fall to $90? Do not exercise the options, gain nothing. If price raises to $110, exercise options, gain equal to $10, expected payoff equal to 0.05 plus 10 into 0.5 which is equal to 5. This is the option premium. What would the option premium be if a stock price could raise or fall by $50 with equal probability? As volatility of the stock prices raise, option premium raises. And now option pricing. As any option gives the buyers a choice, its value cannot be negative at expiration. Value of options equal to intrinsic value. If not, arbitrage opportunities exist that lead to riskless profit prior to expiration. The longer the time to expiration, the greater the chance that the price will change to make options valuable. The longer the time to expiration, the higher the option premium. Option pricing, volatility, likelihood that the options will pay off depend on volatility of underlying assets. Price, one measure is standard deviation, increased volatility has no cost to the options holder. If bad things happen, choose not to exercise the option, only benefits. And now do it yourself. What is option distinguishes from futures? Number two, what are the future and forward contract? And that's it from session number 5. Thank you.